Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Chinese shares lead losses in Asia. Investors sending a signal to Beijing for more stimulus as holiday spending lags pre-COVID levels. Israeli Defense Chief Yoav Gallant's trip to the U.S. is postponed. Bloomberg has learned that Prime Minister Benjamin Netanyahu had last-minute objections to the visit. Plus, in what would be a historic antitrust move, the U.S. Justice Department may recommend breaking up Google to end its monopoly in online search. It has just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. But what we had yesterday was a better end for Wall Street, with both the S&P and the Nasdaq ending up in the green, pairing the prior day's losses. The S&P up more than 1%, Nasdaq up 1.5%, seeing a bit of a rebound for Nvidia. That stock up about 14% just in the last 5 sessions. But once again, overnight, we're seeing some risk-off sentiment prevail coming through, some of those signals coming through from Asian markets. We'll get to that in a second, as the market seems to be somewhat disappointed about the lack of further fiscal stimulus coming through from authorities. And on the back of that, it has been weighing on these Asian equities. Today, you can see S&P futures leaning towards the red. We are down about 0.2%, but again, very close to all-time highs here. Nasdaq also leaning to the red, down about 0.3%. In terms of what to watch out for, of course, big CPI number coming through on Thursday, one of the key data points that the Fed watch out for, and the beginning of earnings season. We will be getting earnings towards the end of this week from Wells Fargo and JPMorgan, so watch out for that. 2-year yield sitting at 3.94. Not a lot of movement. We're about 1.5 basis points lower. The market is still pricing in 50 basis points of cuts by the end of this year. So is the market getting too ahead of itself, given the strength of the U.S. data that's come through, the NFP numbers on Friday, surprising to the upside? That is a question for markets. And then Brent also in focus. Today, a little bit higher, up 0.4%. But what we have seen actually is yesterday's price action was quite surprising. We were down about 4%, and it tells you how much oil has traveled in the very short time frame of the last couple of weeks as geopolitical premium gets priced in. But then equally, the signals coming through from China have disappointed to the downside, which explains some of the price action that we had yesterday. Speaking of China, take a look at this chart. I thought it was really interesting to go back about a year and contrast the respective performance of the S&P, which is up, you can see almost 32% over the course of the last 12 months, versus China, which has done nothing and was trending negative up until a couple of weeks ago. We saw that massive vertical bounce, as you can see, but then the last couple of days, CSI now down about 5%. So yes, we jumped 30%. We're down 5% now. Question is where we go from here. And luckily, we've got Avril Hong back in our Singapore studio standing by to tell us more about this market direction. Avril, it's great to have you back with us.
Great to be back. Thanks so much, Jumana. We're seeing that negativity down on these Chinese equities, which suggests there could be more to go. I mean, you think about how the signal from investors seems to be that whatever stimulus has been announced so far is just not enough. That is the message they're sending to authorities on the CSI 300. This is the worst performance since February 2020. And on the mainland, as well as the Hong Kong benchmark, you're seeing it hovering at lowest levels in 2 weeks. So it really gives you a sense of what investors want to see here. And of course, this bucks the trend of what we're seeing in the rest of Asia, which is more or less tracking Wall Street's climb overnight, with tech outperforming. That is what we're seeing in the Asia Pacific today, Jumana.
Excellent. Thank you, Avril, for the overview. Well, sticking with China, investor sentiment on the economy has again soured after weak economic data from the Golden Week holiday and Beijing's refusal to commit to more economic stimulus. So let's bring in Deepak Mehra, Chief Economist at Commercial Bank of Dubai. Good to have you with us today. It seems, for me, the major question on the back of the stimulus measures that China have announced is whether they're going to be successful at actually bringing the growth rate back to 5%. Do you think they will be successful?
Unfortunately, no. I think the biggest issue will be getting the consumer to start spending again, to leverage again. So none of these measures are going to repair the consumer balance sheet, which is very badly stuck with real estate. I see parallels of Japan in 1989 after the bubble burst. It took decades for the consumers to come back. So what that bubble burst leads to is precautionary spending and, precautionary savings and deleveraging.
And deflation.
and deflation.
So what do you see happening to the renminbi in that scenario? We've been trending firmer. We've got to around 7 versus the USD. Does that keep going then, to your mind?
No, that is also not in their interest because the only other engine that is right now helping the economy is exports. And they don't want a stronger renminbi, but they also don't want a very weak currency. They can't weaken their currency and come out of this crisis because that will lead to more outflow of capital and more pushback from the West in terms of tariffs on the export. So it's a very difficult situation, structural issue.
Sounds to me like you're staying clear of China markets.
I would, and I have, because what this does is these sort of stimulus measures lead to spurts in the equity market that just reinforces the view of the investors that Chinese equities are speculative play. No one is thinking long term, and this doesn't help.
Interesting. So that is your view on what's been happening with China. Obviously, U.S. markets are telling a very different story. We keep going from strength to strength. I mean, even just now, looking back at that chart of Chinese equities versus U.S. equities, it's been steady climb for U.S. equities, vertical jump for China just in the last couple of weeks. How do you see the evolution of U.S. stock markets from here?
I'm very optimistic and constructive on that still, because I think we can have a situation where inflation remains relatively above target. The Fed will cut a bit, but we are ignoring the no landing situation right now, where we may not see a slowdown of economy to the extent that the market is thinking. The Fed may not have to cut as much. And the equity markets don't mind that. The equity markets are more worried about recession, which is nowhere in the horizon.
But would you say that equities are really worried about a recession, given that we're trading at close to all-time highs? I mean, that was the scenario that was being priced into bond markets, which seems to be getting priced out now.
Absolutely. So I think that's what gives more tailwind to the equity is that, 3 months ago, recession was our biggest worry. That's gone out of the window, if you see all the data.
If we do get an upside surprise on growth, as you say, and we end up in a no-landing scenario, where do you want to be positioned? Is it just the same old playbook? It's still going to be the growth stocks, Magnificent Seven, cyclicals? Do you continue putting money into that rather than, say, switch to more defensive plays?
Oh, no. So we wouldn't switch to defensive plays because we think interest rates in that scenario may stay higher than what we are anticipating. Growth stocks would be our first pick. And, of course, the index would do extremely well in that case. And I draw your attention to 1990s, the roaring 90s again. High inflation, high yields, high growth, and the stock market quadrupled.
I want to just draw on a line that I thought was really interesting out of a conversation our colleague Lisa Abramovich had yesterday with JPMorgan CEO Jamie Dimon. And one of the topics that came up was the size of the U.S. fiscal deficit. And what Jamie Dimon was saying is markets are not factoring in it enough, the structural higher deficits that we're looking at in the U.S. economy over coming years, but it will get priced in at some point. And structurally, the shape of the yield curve may have to change to reflect those dynamics. Do you think there's a little too much complacency in these yield curves here, if you look at the state of U.S. public finances?
Yes. I think to an extent, yes, the deficit will increase. But let's not forget, U.S. economy grows at a very robust pace. So deficits are relative to economic growth. So in absolute terms, it doesn't scare us because the economic growth is likely to pick up and stay strong. And therefore, deficits in relation to the economic, to the size of the economy may not pose as much of a risk as the market is worried about. It's fine. We need to worry about these things. But this is not a top worry of the equity markets or investors.
Well, what would you say is the biggest risk now? Is it geopolitics and what's happening in this part of the world?
I think to a limited extent, we think this will be contained and this will not impact the U.S. markets. And we think that the U.S. market is in a secular bull story because of the U.S. exceptionalism that we've seen, a variety of reasons for that. And the consumer will stay strong. And we feel that the economic growth will ensure that deficits and the debt levels do not become one of the top worries for us.
Well, Goldilocks view of the world, I got to say.
It looks like.
Well, it's good to have you on. It's funny that being so bullish makes you an outlier in these markets. It's good to have you on. Deepak Mehra, Chief Economist at Commercial Bank of Dubai. Well, Israel's defense chief postpones a planned trip to Washington. We're going to be talking more on that and what it means next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. The Pentagon says a U.S. visit by Israel's defense minister, Yoav Gallant, has been postponed. Bloomberg has learned it's because of last-minute objections from Israeli Prime Minister Benjamin Netanyahu, and the visit was billed as a chance for the allies to craft a common strategy in a face-off against Iran. Now, Axios is reporting that President Biden is due to speak with Netanyahu later today. For more on this, Bloomberg's UAE Bureau Chief Dana Khish joins us now. Dana, tell us, why was the trip postponed?
The trip was scheduled for Gallant to go to the U.S. and discuss with U.S. officials the response to Iran's missile attack last week. This was supposed to be very significant and very important, so we actually carved the path towards what we can expect in the region. Is it an escalation, or is it more, reducing these tensions and calming things with the Lebanon situations flaring?
Yeah.
And now it seems that Netanyahu doesn't want Gallant to go to the U.S. before discussing and approving or agreeing on that response. Maybe Netanyahu here doesn't want the U.S. to dictate what kind of response Israel would have to carry out.
Yeah.
And there are a lot of options, and the U.S. already rejected the nuclear facility, targeting nuclear facilities. And oil facilities would also be something the U.S. might not want Israel to do.
Yeah.
So we're left with, Iranian commanders, maybe IRGC somewhere else, maybe in Syria. We saw an attack in Syria yesterday as well. We're not sure if this is the response, but it doesn't seem like it.
Yeah, or even whether the Israeli Prime Minister will actually heed U.S. advice at this point. Dana, talk us through some of the latest developments as well, because, again, the conflict is raging and intensifying both within Gaza and Lebanon.
Exactly. In South Lebanon, there isn't much of a clear picture about where Israeli troops are in or not. So the Israeli Defense Forces keep saying that we are conducting these targeted, limited raids into Lebanon. So that means they're going in and out. And Hezbollah keeps putting out these statements saying, we stopped an advance by the Israeli army towards Marun al-Ras, towards Yarun and other places, but it doesn't seem like they are inside Lebanon. It's hard to tell. The UN peacekeepers would so-called UNIFIL now, are saying that the Israeli troops were close to a point that they are stationed at in Marun al-Ras, but then they had withdrawn. So it's really tough to say what the situation is in South Lebanon, especially with the border towns. But yes, the airstrikes are continuing, especially in Beirut's southern suburbs, targeting Hezbollah and really decapitating the group after the killing of so many of its leaders.
Yeah, also interesting to hear from the Deputy Secretary General yesterday, Naim Qasim, suggesting that they would be open to a ceasefire. But of course, so much has happened in the last week. It's difficult to see how we're going to get there. Dana, thank you so much for the reporting. That was Bloomberg's UAE Bureau Chief, Dana Khish. Now, the U.S. is weighing a breakup of Google as a remedy in its monopoly case. The DOJ may force Google to sell off parts of its operations, seeking to prevent it using products, including Chrome and Android, to its advantage. Let's get more with our tech reporter, Annabelle Jewelers. Annabelle, it feels like this could be a really significant event, obviously historic in the context of potential breakups. Just give us more details on how the DOJ came to this decision.
Well, it follows, of course, we had that decision over the summer from the US judge in this case, Amwal Mehra, saying that actually Google was illegally monopolizing the online search market. That was the ruling, and now we're moving to the remedy part of this. And that is why the DOJ is putting forward this filing to that US judge, talking about what it's recommending should happen in this case. So we've got that 32-page document, and there's some quite extreme proposals that are included in it. Again, at that higher end of what could be put forward is forcing Google to sell part of its business operations. So that would be breaking it up. Then you've got other possible solutions as well. So that would include a Google unit forcing them to provide the underlying data that it uses to build search results in its AI products. That's one of them. It could also seek a requirement for Google to allow websites more ability to opt out of its AI features. Lots of different solutions are being proposed by the DOJ here. Of course, what we're talking about in terms of that overall significance is the first time really that we've seen Washington pushing to possibly break up a major US tech giant going back to Microsoft, and that was 2 decades ago, but that effort, should note as well, was unsuccessful.
How likely is it that Google actually give in to some of the requests that have been put forward by the DOJ? What has their reaction been so far?
Well, unsurprisingly, Google has pushed back quite strongly. So we had a comment or a statement out from the company earlier saying that the DOJ filing is radical in what it's pushing forward and that it's also going to have pretty broad consequences, they're saying, for consumers and for businesses that use their products. So they're saying that the decision, that blueprint, goes far beyond the scope of what the judge ruled in their search distribution contracts. And so they're saying that essentially they are prepared to fight this through the courts. Amwal Mehra, as we said, the US judge in this case, has plans to hold that remedy trial next spring. The decision could come by August 2025 in the case as well. Google is already saying it is prepared to appeal the decision, but they have to wait until that remedy comes through to do so. So, as we said, this could be something that is quite protracted. We know that Google intends to fight it. Wedbush Securities, we've spoken to Dan Ives from there, saying that a breakup, an eventual breakup, is unlikely at this point in time.
Dan Ives, the perpetual optimist. Annabelle Jewelers, thank you so much for bringing us the latest on this very important story in tech space. Annabelle Jewelers in Taipei. Well, coming up, JPMorgan CEO Jamie Dimon says the Fed was right to take its foot off the gas in its fight against inflation. Our exclusive conversation next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. JPMorgan CEO Jamie Dimon says the Fed was right in making a 50 basis point rate cut to avoid recession and tackle rising unemployment. Dimon spoke exclusively with Bloomberg, also weighing in on the U.S. economy's trajectory and market valuations.
Soft landings are hard. I hope it happens. I don't know. I just wouldn't count my eggs in that one.
Do you think
and markets are open. When you say open, they're very, values are high. They're not low. Both equities and bonds, credit spreads are very low. So they're open, but people are saying they're not open for IPOs. So some IPOs, when we just did one of the largest ones of the year, like last week, they're open for those who the market wants to buy today. But don't assume that they're not open. And, sometimes people would go public, they don't like the price. That's a very different thing. And you should think twice about that when you think what a company's worth much more than the market might know.
Yeah, that maybe it's an assessment of what you're looking for rather than the actual market being closed.
Exactly.
You said that there are a lot of inflationary things that are coming down the pike. Do you think that it was a mistake for the Fed to cut by 50 basis points?
No, actually. You got to separate the here and now. Inflation has definitely been coming down. They don't want to go into recession. Unemployment has been going up. They raised rates. They were late raising rates, but they raised it very high, rapidly to 5%, which I think is the right thing. And they're right to take their foot off the gas in that one. I don't think it matters that much, 50, 25, honestly. But I think that was okay. If inflation comes back, I'm looking at future things. The remilitarization of the world's inflationary. The fiscal deficits of the world, particularly the United States, are inflationary. The green economy is inflationary. Demographics are inflationary. It's very possible energy prices down the road, I'm talking about 2 or 3 years, will be inflationary. Those will hit later. They should react at that time to those things, but I don't think you can anticipate that. We don't know that that's going to happen.
I'm so glad you brought up the deficit. I watched the Treasury auctions. There's another 3-year one today. I watch them every time wondering, are we going to start seeing disruption from some of the concerns that that you bring up, but also every single investor who I speak to says the same thing. Are you surprised that the market hasn't priced in a higher structural deficit in the way of higher yields or at least more volatility, at least at auctions?
Yeah, well, I have a lot of comments on that one. Commodity markets often don't price things in until they actually happen. And so it hasn't happened yet. The higher inflation, the higher structural stuff, even though the deficits are there, there's also sentiment, inventory, supply and demand of capital goods. So it's very hard to say. But that's why I think that longer rates may actually stay here and tick up a little bit as opposed to go down because of these huge deficits in the United States. And then the market's reacting, which the word you used of volatile or something like that, it's not always bad. I mean, I think we overreact sometimes to volatile markets, but I do think they'll happen again. Dealer inventories are very low. Banks the big market makers are very constrained. Not today. I mean, we have this anomaly where JPMorgan is going to have $1 trillion of cash and unable to intermediate in treasury markets or repo markets completely conservatively because we're required to hold that cash in very, like central bank reserves, something like that. So I think when QE finally gets to a certain point, you will see that. I may be wrong. And again, if it happens, I don't think it's a disaster. It's not bad for JPMorgan. I do think policymakers will get upset. They don't like seeing that type of thing. And I think there are fixes to it, and I think they should start working those fixes today.
JPMorgan CEO Jamie Dimon speaking exclusively to Bloomberg TV's Lisa Abramovich. And you can watch the full interview on the terminal. It's about a 20-minute long discussion. Now, for a look at some of the other stories we're following. Hurricane Milton is now set to hit Florida's Gulf Coast later on Wednesday after regaining Category 5 strength with winds of 260 kilometers an hour. Officials say flooding and high winds may inflict widespread damage and put lives at risk. Milton could potentially deliver the Tampa Bay area's first direct hit from a hurricane in a century. The region is home to more than 3 million people, NASA's Kennedy Space Center, and Florida's largest port. China is investigating whether to raise tariffs on European large engine vehicles and will start collecting levies on brandy. It is an escalation of their trade spat after the EU voted last week to impose tariffs of up to 45% on Chinese electric vehicles for 5 years. The European Commission says it will challenge the Chinese measures on brandy at the WTO. Brazil's Supreme Court has authorized the return of social media platform X after Elon Musk complied with its demands. That includes removing some user accounts and appointing a legal representative in the country. The order ends a months-long feud between Musk and the Supreme Court, which blocked X in August after Musk flouted Brazilian regulations. And a quick look at equity futures before we head to the break. The handover from Asian markets has been negative once more with a big pullback for Hang Seng and CSI, with the Chinese market in the red after its second day back from a public holiday. All of the futures into US and Europe also seen opening in the red as well. Now, coming up, as the world awaits Israel's next move against Iran, Tehran is warning any attack will be met with a more powerful response. An update next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Chinese shares lead losses in Asia. Investors sending a signal to Beijing for more stimulus as holiday spending lags pre-COVID levels. Israeli Defense Chief Yoav Gallant's trip to the U.S. is postponed. Bloomberg has learned that Prime Minister Benjamin Netanyahu had last-minute objections to the visit. Plus, talks between Boeing and its largest union to end a strike break down again. The plane maker also contending with a possible debt ratings downgrade as the shutdown looks set to drag on. It's just gone 8:30 a.m. across the Emirates. I'm Joanna Bersachi in Dubai. Better session for Wall Street yesterday. Both S&P and Nasdaq ending up in the green. The Nasdaq up 1.5%, seeing a bit of love come back into these tech names once more. Nvidia up 14% just in the last 5-day trading days. So even though we talk about the geopolitical situation in this part of the world and some of the negative signals coming through from China with the turbulence in Chinese equities, U.S. markets keep going from strength to strength. Bear in mind, we've got the CPI print Brent to watch out for tomorrow, and then a Friday, the beginning of earnings season. So we're getting into earnings season once more, something to watch out for. As for today, we're leaning towards negative with that somewhat of a risk-off handover from Asian markets. We'll get to that in a moment. Two-year yields just sitting at 3.95 now. The market is still pricing in 50 basis points of additional cuts out of the Fed this year, maybe getting a little too ahead of themselves. Also of note, today we get the FOMC minutes. Remember, as far as the dot plot is concerned, there's only about 25 basis points median extra cuts priced in. So again, something to bear in mind. And then Brent, energy complex has been a big mover the last week or so, ever since the Iran ballistic missile attack on Israel. We've shot up about 12, 13%. But yesterday, we pulled back quite a lot, and namely on back of those weaker signals coming through on China. So on one hand, you've got fundamentals. On the other hand, you've got geopolitical concerns as well. As for our terminal chart today, just very interesting to take a look back at the divergence of performance between U.S. equities, Chinese equities over the past year. And you can see S&P is up almost 33% over the course of the last 12 months. And up until a couple of weeks ago, Chinese equities were lagging, down about minus 14% over the course of 11 and a half months. But in the last 2 weeks, we shot up 30%. And in the last 2 days, we've pulled back around 5%. So a really volatile couple of weeks for Asian markets. But let's get more information, not just necessarily on China, but also on India markets, because I believe the RBI have just come out with their interest rate decision. Avril has more.
Yeah, we are awaiting the decision from the Reserve Bank of India. Consensus is for it not to cut rates just yet at this review and for it to only move in December, although we have our colleagues at Bloomberg Economics saying that there is a case for a cut at this meeting, simply because if you look at the growth risks, if you think about the hostilities surrounding the Middle East, that could also affect the supply chain, and there are concerns there that it could affect India's growth. And then, of course, don't forget how the Federal Reserve, moving with that 50 basis point of easing, is just opening the door for a lot of these EM central banks to start cutting off their own. And that's also removed some of the concerns surrounding yield differentials. You're looking at pictures there of the Governor Shaktikanta Das. We're waiting to hear not just on what the decision is ultimately, are we going to see a cut, but also, more importantly, the stance of the RBI. It has been pretty hawkish recently, and the investor sphere is really watching to see whether this is going to, foreshadow a bit of a shift towards a more neutral tone of late. And we are seeing that decision. It has left rates unchanged. This is as expected, so it looks like we will have to wait a while more for India's central bank to cut on rates. And if we can just take a look at what we're seeing in terms of the market reaction, of course, as you know, the RBI has been keeping the rupee pretty steady, or helping to at least. India's bond markets did see a bit of a climb just a day ago, as our stock markets, you're seeing that firming up a little at the moment as well, Jumana.
Yep. Thank you so much for the overview. So it looks as though the markets will have to wait a little bit longer to start with the easing cycle out of India. Thank you so much for the overview there, as RBI have decided to leave their interest rates at 6.5%. More now on the postponement of the Washington visit of Israel's defense minister. The trip was highly seen as a chance for Yoav Gallant to discuss Israel's long-awaited response to Iran with its key ally. Israel is warning its retaliation against Iran will be significant, while Tehran says any attack will be met with a more powerful response. To talk more about this, let's bring in Bloomberg's Middle East breaking news editor, Patrick Sykes, who joins us from Istanbul. Patrick, great to have you with us. First of all, how is Iran preparing itself for this possible retaliation?
Yeah, the messaging in Iran has really moved in the past few days to how Iran would respond to the expected Israeli response. So we're now in the second order situation of responses. We've had one state-owned newspaper, Ham Shahri, publishing a map this week showing possible Israeli infrastructure targets that Iran could respond with attacks towards. That's obviously a kind of equivalent to the potential scenario of Israel targeting Iranian oil infrastructure or energy infrastructure more broadly. And then there was that line out of the foreign minister that you mentioned just yesterday, Iran saying that any response will be met with a more powerful one. So that just underlines the escalation risk. I think here, obviously, in April, the equivalent ratcheting up of tensions that we had, the Israeli attack that responded to Iran sort of drew a line under the tensions and for a time at least did see things cool down. Iran saying, look, if you escalate too far here, we're willing to do the same and take things even further.
Yeah. The interesting thing, Patrick, is, and you mentioned some of the sequencing here, I think the big event obviously was the killing of Ismail Haniyeh in Tehran. And that was met with a lot of rhetoric by the Iranian regime. There were lots of words put out, and there was a sense that they were going to retaliate, but unclear when. And then a few months later, obviously, the head of their crown jewel in this axis of resistance, Hassan Nasrallah, was also killed. It was only after that this Iranian response came through. And some people are saying that it was actually Israel who forced Iran's hand here. They didn't want to actually escalate, but they had to after the killing of such significant political leaders. What is your point? What is your take?
I think the message from Iran, how they've tried to frame that is, look, after the Haniyeh killing, we were giving a chance for a Gaza ceasefire. But it's, after the killing of Nasrallah and the subsequent incursion into Lebanon, things have reached a point where they can't ignore that. Now, that's obviously, to an extent, rhetoric itself. I think it remains to be seen whether Israel would buy that. It also gave them a kind of an off-ramp to, present themselves as the party looking for diplomacy. But that was the message at the time. I think now, though, as you say, after these subsequent events, they're back to this idea of they really need to restore deterrence. Again, it may be sort of, as in April, that becomes a kind of phantom deterrence where for Israel, they've made their point very clearly, but the attack was of such a nature that Iran could pass it off as fairly minor and successfully restore that deterrence. That's the calculation they're going to be making now.
Yeah. The other story that I've been reading about is that there actually is a lot of discussion going on at the higher levels of the regime at this point. You've got the hardliners, as represented by the Ayatollah and other senior IRGC commanders, but then the president represents a perhaps more moderate face. And we all heard his speech at the UN General Assembly. He was almost putting out an olive branch. He was signaling that they were ready to start discussions, possibly on their nuclear development facilities. So how do you weigh up the two together? And is there a battle going on internally between the hardliners and those who want more discussion and more diplomatic channels to be opened with the West?
I think for sure. I think just as in Israel, it seems based on this postponement of the defense minister's trip, there's obviously deliberations going on there as well and a need to present a united front. For sure, that's the case in Iran as well. You're right, he was presenting this face of outreach, olive branch, and so on. And perhaps if Nasrallah hadn't happened, if the Lebanon invasion hadn't happened, we might have seen some progress on that. Although I think with the Gaza backdrop, it would still have been very difficult. But obviously those subsequent military, political escalations, Iran firing missiles, they just undercut that message so much that it's, I think, unthinkable that there's going to be any progress until we return to some kind of status quo.
Yeah, that is the big question, and indeed how we even get to that new status quo. Bloomberg's Middle East breaking news editor Patrick Sykes, thank you so much for joining us today on the show. Well, oil is steady this morning after falling at the most in more than a year in the previous session on concerns around China's economic outlook and as traders watch for Israel's response to Iran's missile barrage. Let's bring in Zeina Rizk, co-head of fixed income at Amwal Capital Partners. Well, what a time for the region. I was just speaking to our Iran correspondent. You've got on one hand the geopolitical risks, which of course are very prominent. On the other, the price of oil has ticked higher. And you could say that actually that's a good thing for some of the oil exporting nations in the GCC. So how do you square up the two risks together?
It's good to a certain extent, right? I mean, fundamentally, we had expected oil to drop. We had expected oil to be more in the range of even as low as 60 to 70, or it could go lower even to 50 at some point. We expected the GCC to come back, the OPEC to come back to their previous production level, which was going to cause a downward pressure, adding to that a potential slowdown in the Chinese economy and potentially in the US. The flip side of that is the escalation. Markets have not reacted to any escalation yet. Yeah. Spreads do not discount that. Oil reacted a bit, but still, there's no panic there. So yes, higher oil is good for the exporters, obviously, but depending on how high and what's causing it to be that high.
Why do you think credit spreads have been so immune to everything that's happening in the region?
I think the escalation has not been, like, participants are not discounting this. They're still seeing it as a tail risk because discounting this would be to pretty much significantly wider spreads. The flip side of that is the stimulus that happened in China also supported the market.
Yeah.
The 50 basis point cut from the US supported the market. So you've also had this fundamental versus what's happening in the region.
Issuance has been quite high this year. And I was just reading in your research that Saudi Arabia have accounted for about 50% of the MENA issuance that's come to the market. Absolutely. And yet Saudi Arabian credit spreads are also pretty tight as well. Is the market not concerned about how much debt issuance Saudi's bringing?
I mean, if you compare Saudi to other IG in the region, they trade significantly wider than that, and for a reason, for obviously the significant amount. I mean, you're at 50 billion, 54 billion between Saudi and GREs. There is demand still. You're still a very highly rated corp that trades significantly wider than others. So there is still demand. We expect next year to remain the same. So absent a significant drop in oil, we think that Saudi paper can still come to the market and they can still be discounted.
Where are you seeing opportunities right now in local fixed income?
So the way we're looking at it is we're reducing the very low high yield positions. We're moving more to BB plus, BBB minus because of the expected uncertainty and the volatility that is upcoming. And I don't think that you are rewarded to go there. So if we have a risk-off scenario either driven by an escalation or by the US economy, I think that those are going to sell off. So we like more around the IGs, around the IG or BB plus space. We still like Turkey local currency. I think it still offers value. And we are neutral on duration, started to extend a bit given the level that we're in, but we're still not very...
And how does where you put your money, how is it going to be affected by what the Fed eventually end up doing? Because they've cut 50 basis points, that the signals from the US labor market are still pretty solid. You've got the likes of Ray Dalio saying investors will likely be disappointed because they priced in too much now out of the Fed. If the Fed don't actually implement what is priced in terms of rate cut expectations, could we see an uptick in credit spreads?
I mean, the way we're looking at it is the job market caused a significant volatility last week, but I don't think that one job market is enough to change the course of the Fed. We're going to have to wait and see inflation. Market have been over-discounting cuts from the beginning of the year. They expected to start in Q1, and then it has been moving forward. For now, we still think that 25 basis points are going to be there. Any significant difference from that will cause a sell-off, but I don't think a small difference will cause a significant sell-off and spread widening.
Well, you're my second bullish person to come on the show today. We had an equities bull earlier on, and now we've got a fixed income bull too. Zeina, thank you so much for joining us. A pleasure to have you on. Zeina Rizk, co-head of fixed income at Amwal Capital Partners. And coming up, Mozambicans are voting for a new president today as the government faces many, many challenges. We have all the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Let's turn our focus to Mozambique, where voters are heading to the polls for the presidential election today. The new leader will need to quell an uprising that has stalled massive natural gas projects. Ruling party candidate Daniel Chapo is seen as the clear frontrunner. So let's bring in our Africa correspondent Jennifer Zabazaja, who joins us from Johannesburg. Jen, what makes this election significant for Mozambique?
Right, Jumana, we've been paying close attention to this for a number of reasons. If we take a look at this, I mean, we talk about the current president, Philippe Nyusi. He's going to be leaving power after serving 2 terms, but also many people are suggesting this was really going to be a changing of the presidential guard. A lot of the previous leaders had fought during independence from Portugal, and now that frontrunner, you mentioned Daniel Francisco Chapo, he is the ruling party candidate, likely to be the next president, potentially, but we could see a new era of leaders going forward. And if you just take a look at some of the other candidates, it's interesting to see their own messaging, because we have the ruling party that has been in power since independence in 1975. We've seen the country go from one of the most thriving on the African continent to being in a deep economic crisis. And so some of the other candidates have been drawing crowds by saying that they can save Mozambique, potentially reaching out to the youth who have low or high unemployment, and so it's really an opportunity for this next administration to turn things around if they are to get a hold of a lot of the issues that have set the country back.
Of course, he does hail from one of the leading political parties that has been governing Mozambique for many years now. So how could this vote shape future partnerships between Mozambique and potentially multinationals?
Right. So, Jumana, we were just taking a look at that full screen, which is important to note. There has been this LNG project that was once touted as Africa's biggest private investment, $20 billion of Total Energies, that has been halted for the past 3 years because of security concerns in the northern part of Mozambique, Cabo Delgado. And so that has just been one of many multinationals that have really sat on the sidelines because of the security issues. We actually spoke to Daniel Francisco Chapo about his own plans for security in the country. Take a listen to what he told us.
It's worth saying that the issue of terrorism in Cabo Delgado is an issue that has nothing to do with political parties. It is an issue of the Mozambican state and sovereignty. And it is also necessary to explain that terrorism is jeopardizing our independence, our territorial integrity, and also our sovereignty. So at this moment, the most important thing is to understand that after winning the elections, we will have to work to put an end to this evil in those 2 approaches, which is combating on the ground, but also the issue of dialogue with those who might be part of the situation.
And Jumana, we also heard this week from Total Energy CEO saying that he plans to visit Mozambique in the new administration, and he sees that the issue of security has improved, potentially opening the door for the project to resume. Also, the U.S. saying that they do see potential private investment if a lot of these concerns that have bogged down the economy can get resolved.
Jennifer Zabazaja, thank you so much for the report as Mozambique heads to elections. Now, coming up, turbulent times. The talks between Boeing and its largest union have collapsed for a 3rd time. More on what this means for the embattled plane maker next. This is Bloomberg. Talks between Boeing and its largest union to end an almost month-long strike have collapsed for a 3rd time. This follows 2 days of mediated negotiations over a proposal that would have hiked wages by 30% and boosted retirement benefits. To talk more about this, Bloomberg's aviation reporter Danny Lee joins us now. Danny, so this is the 3rd time that the talks have ended indecisively. What brought around these latest talks to a halt? What was the issue?
It depends on who you ask, frankly. Well, Boeing is very clear that there was no movement on the union on its non-negotiated offer, rather, on having bigger increases in salary and benefits. And so, what Boeing had originally offered in its most recent proposal a couple of weeks ago, which included a 30% pay raise and improvements to the retirement benefits, there was little change there, and for the union that was a non-starter. And for the union, clearly, it wants something much bigger still. It wants 40% increases and bigger changes to its pension and retirement benefits. And so we are really at an impasse here, frankly. And for Boeing, it says what the union wants is not going to be sustainable for the business to remain competitive. And so we are really at a stalled point here. And for Boeing, as long as these strikes go on for, it's losing around $100 million a day in revenue.
Wow. Well, I was going to say, you know, what impact has this all had on the business? And I saw overnight as well, S&P warning that they may actually have to downgrade Boeing and it may end up in junk rating territory. So it feels as though the longer this strike goes on for, the more of a material impact it's actually having on Boeing's finances.
Yeah, absolutely. The latest news on these talks stalling would not be good news for the credit rating agencies who are monitoring what is happening. And so clearly that is a big risk, losing potentially its investment grade rating. And therefore, where we see Boeing go next is talked about, you know, deepening its cash preservation measures. So we may not see more improvements on the offer if it ever gets to another round of talks in the near term, but maybe it has to deepen its cost cuts, and that's something we're watching out for next.
Danny, always good to talk to you. Pretty astonishing price action, though, in Boeing over the course of the last year. The stock is down 40%, and yet another round of failed discussions with the union workers. Bloomberg's aviation reporter, Danny Lee, thank you very much. Well, let's just recap some of the price action that we've had in global markets. And I've been talking about three distinct themes going on here. We've had some of the initial positivity that has come out of China with that stimulus has started to fade in the last two sessions. We have seen pullbacks for both Chinese and the Hang Seng indices and overnight, with some of the 30% gains over the last couple of weeks being wiped out now, so about 5% lower over the last couple of days. And then you have the geopolitical developments in this part of the world. Things don't seem like they're getting any better. And then on the other side, you've got the U.S. with the positive signals coming out of the U.S. economy. We're keeping a close eye out for that CPI number coming on Thursday, in addition to the beginning of the U.S. earnings season. So three themes playing out here. All of these futures are looking negative as we head into the European session. That was our show. Stay with us for Daybreak Europe. This is Bloomberg.